Welcome back to the deep dive. Today we are taking a really fascinating journey right into the heart of business strategy and value creation.
That's right. We're looking at what the pros call the economic moat.
That famous Warren Buffett analogy, right, about defending against profit-stealing marauders.
Exactly. And our guide is this fantastic research paper, Measuring the Moat, by Mauboussin and Dan Callahan. It just came out October 2024.
Okay, so what's the mission for us and for you listening?
Well, this deep dive is really about giving you a shortcut, a systematic way to understand how companies build these durable advantages.
And how to quantify them.
Yes, how to put numbers on them, and maybe most importantly, how you can take these big strategic ideas and, relate them back to your own decisions.
Okay, let's jump right in then, because if we're talking value creation, we need a solid definition. It starts with the financials, doesn't it?
It absolutely does. And it's simpler than you might think at its core. A company creates value when the cash it gets back from its investments. Well, when that cash exceeds what the investments cost in the first place.
And that cost isn't just the sticker price, right? It includes the cost of the money itself.
Precisely. The opportunity cost. We call it the weighted average cost of capital, or WACC. It's what the money could have earned elsewhere.
So the metric we're hunting for is the gap. The positive spread between ROIC, return on invested capital, and that WACC.
That spread is economic profit. If your ROIC is higher than your WACC, you're genuinely creating value. You're making more money than your capital costs you.
But the key word is sustainable value creation.
Right. It means keeping that positive spread going for a long, long time. Now, here's a really important distinction the paper makes.
Okay.
You have to separate sustainable value creation from sustainable competitive advantage. They sound similar, but they're not quite the same thing.
Ah, okay. Give us an example. That feels like something we need to nail down.
Think about Coke and Pepsi, giants of the soft drink world. If you look at the U.S. stock market history, say from 1926 all the way to 2023, both are right up there in the top performers for long-term returns.
So they both created massive value over time.
Immense sustainable value creation.
Yeah.
They both achieved high, durable returns because, frankly, the industry structure itself is pretty favorable. But competitive advantage, that's about generating an ROIC that's consistently higher than your direct competitors.
So even if both are doing great, the strategic battle is about who has the slightly better setup, the wider moat relative to the other guy.
Exactly. They can both be fantastic value creators, but the competitive advantage piece is about that sustainable difference between them.
Okay, that makes sense. But the paper immediately throws cold water on this idea of easy, sustained profits, right? It talks about the cruelty of the mean.
Oh, it's fundamental. Regression toward the mean. It's maybe the single most powerful force in business economics. It's this undeniable pull, this tendency for high returns, high ROICs to just fade back towards the average over time.
Why does that happen? Is it just bad luck?
Not usually. It's competition. Success attracts attention. If you're making great profits, others notice. They imitate you, they add capacity, prices start to fall, and suddenly that juicy spread you had, it shrinks or disappears entirely.
And the paper has data on this.
Yeah, Exhibit 1 is pretty stark. It shows substantial reversion just looking at U.S. companies between 2013 and 2023. High performers saw their ROICs drop significantly closer to the average.
So the takeaway for you listening is, don't get complacent. A great quarter or even a great year doesn't automatically mean the company has a lock on future profits.
Absolutely not. If that performance is just down to, say, a lucky break or being in the right part of the economic cycle or having a hot product that anyone can copy, the market will correct that very quickly.
The only way to fight that gravitational pullback to average
is to build a moat. Real structural defenses. That's what strategy is truly about. Not just getting high returns, but figuring out how to keep them. Hashtag the expectations gap and the engine of profit.
Okay, let's link this moat concept directly to the stock market. Because for investors, today's price reflects what the market thinks will happen tomorrow. What drives the stock price, fundamentally?
You can basically split it in two. Think of it like this. Component one is the value of the company just ticking along as it is now, operating at a kind of steady state profit level, if nothing changed.
Like the value of the current business, assuming it just keeps going.
Right. But the second part, and this is often the more volatile part, is the value the market assigns to future value creation. What it anticipates the company will achieve, or maybe destroy, with its investments down the road.
So part one is the now, part two is the what's next. How much of the price is typically based on that what's next piece?
Historically, looking at the S&P 500 from, say, 1961 to mid-2024, it averages out to about 2/3 reflecting that steady-state value. And the other third? That remaining 1/3 is typically the market baking in anticipated future value creation. But, this is a big but, that anticipation piece swings wildly.
Like during bubbles or crashes.
Exactly. Think 1999, the dot-com peak. That anticipation component was enormous. People expected revolutionary growth. But then look at tough times like 1974, maybe 2011. The market priced in almost no future value creation. It was all about survival.
So that 1/3, the expectation part, that's where the perception of the moat really lives in the stock price. And when those expectations crumble,
You get disasters. Blockbuster Video is the poster child for shattered expectations. At its height, $5 billion market cap, stores everywhere.
I remember lining up there on Friday nights.
We all do. But here's the killer detail from the paper. About 15% of Blockbuster's revenue came from late fees.
15%, just from people bringing tapes back late.
Yep, and customers hated it. It was pure friction. So when Netflix came along, first with DVDs by mail,
Yeah.
what was one of their biggest selling points?
No late fees.
No late fees. They attacked Blockbuster right where its model was profitable, but also deeply unpopular. Then came streaming, and that just accelerated the whole thing.
So Blockbuster's expectation of future profit just evaporated.
Completely. They went bankrupt in 2010. Meanwhile, Netflix, mid-2024, pushing a $290 billion market cap. The failure wasn't just missing the tech shift to streaming, it was clinging to a profit source late fees that actively harmed customer goodwill. It reduced long-term willingness to pay.
A fundamentally weak spot in their moat. Okay, that shows the result of bad strategy. Let's dig into the cause, the microeconomics of it all. What's competitive equilibrium?
Right, this is like the Econ 101 baseline. In a world of perfect competition, the price settles exactly where the customer's willingness to pay, their WTP, meets the producer's willingness to sell, their WTS.
And WTS is basically their cost to make one more unit, marginal cost.
Essentially, yes. And in that perfect equilibrium, ROIC equals WACC. There's no economic profit, zero. All the value created goes to the consumer as consumer surplus.
Sounds like a terrible place for a business owner. You're just breaking even on your capital cost.
It is, which is why the entire point of strategy is to break that equilibrium, to achieve what economists call market power. The ability to consistently price above your marginal cost. That difference, that wedge between price and cost, that's your economic markup. That's the profit. That's a sign of a moat, however small.
So for you listening, the actionable takeaway is it boils down to two core levers.
Pretty much. You either find ways to increase what customers are willing to pay, shift that demand curve up, that's differentiation, or you find ways to lower your costs, your willingness to sell, shift the supply curve down, that's cost leadership, or the holy grail, you manage to do both at the same time.
Okay, that's the firm level. But companies don't operate in a vacuum. We need to understand the landscape, the industry itself. The paper distinguishes industry life cycles from company life cycles. What's the difference?
Yeah, it's important. An industry cycle is about the whole sector. See patterns of entry, growth, maturity, maybe decline for the entire market. Think typewriters, maybe.
Right, obsolete industry.
But a company's life cycle is way more dynamic. A single large company might have, say, 5 different business units, and each one could be at a totally different stage. One might be an introduction, another mature, another growing fast.
How do we categorize those stages?
The paper uses Dickinson's classification scheme. It looks at cash flow patterns from operations, investing, financing, to sort firms into 5 stages: introduction, growth, maturity, shakeout, and decline.
And what does the data show about profitability across these? Where's the money made?
Well, the bulk of companies, maybe 3/4, are in growth or maturity. Introduction is tough. Average ROIC is actually negative 2.8%.
Makes sense. You're spending a lot to get started.
Exactly. Growth looks better, ROIC around 10.6%. Maturity slightly higher, 11.2%. But then you hit decline, and ROIC just tanks, negative 12.0%. It shows the real danger of sticking with a dying market.
But the key insight, and this offers some hope, is that companies aren't locked in, right? You can move between stages.
Absolutely. This isn't destiny. A company sitting in maturity doesn't just have to wait for decline. If management makes smart investments, enters new markets, develops new products, they can actually shift the company back into growth.
That's the strategic challenge then. Keep finding ways to restart the growth engine.
Precisely. Defy the industry clock.
Okay, let's talk about tools for analyzing this industry terrain. First up, the industry map. What is that?
Think of it as a picture of the entire ecosystem. It maps out all the players that influence profitability, not just your direct competitors and customers.
Who else is on there? Using the airline example from the paper.
Right, so for airlines, you've got the airlines themselves, obviously, plane manufacturers like Boeing and Airbus, airports, but also engine makers, fuel suppliers, labor unions, government regulators, even travel agencies. And increasingly, you have to map geopolitical risks too.
What's the practical value for an investor using this map?
The insight is that shocks often ripple through the system in ways the market doesn't immediately price in. Say there's a big safety issue with a specific engine type.
That doesn't just hurt the engine maker.
No. It hits every airline that uses that engine. It might affect maintenance providers, maybe even airports if flights are grounded. Understanding those connections on the map can help you spot opportunities or risks before the rest of the market catches on. It's about seeing the second and third order effects.
Okay, map done. Next tool. The profit pool. This sounds revealing.
It really is. The profit pool analysis looks at where the actual economic profit, remember ROIC minus WACC, times the capital invested, is being generated within that entire industry map. Who's capturing the surplus?
And the aviation industry example in 2022 is, well, shocking.
Understatement. The aggregate economic profit for the entire global aviation industry ecosystem was negative $69 billion.
Wait, negative $69 billion destroyed across the whole system. How is that even possible for such a vital industry?
It speaks volumes about the brutal economics. The airlines and the airports, they hold most of the invested capital, the planes, the gates, the buildings, massive investments.
But they weren't making the money.
No, they were generating negative economic profit. Why? Intense competition, high fixed costs, huge capital needs, and significant bargaining power held by suppliers. Think fuel companies, aircraft manufacturers, sometimes labor.
So who is making money in that negative $69 billion pool?
Smaller, often more specialized segments. Maybe certain maintenance providers, specific IT systems for airlines, perhaps parts of the fuel supply chain, segments with less competition or more pricing power.
And this isn't a blip for airlines, is it?
Not at all. The paper shows historical data, 1963 to 2023 for U.S. airlines. Consistently, year after year, the industry as a whole failed to earn an ROIC above its WACC. It's a structurally challenged industry.
So the takeaway is industry structure matters a lot.
Yeah.
It sets the stage. It doesn't mean no airline can ever have a moat, but it tells you just how high the bar is.
Exactly. You're swimming upstream from day one in an industry like that.
All right, we understand the terrain. Now let's get into the defenses, the castle walls. Porter's 5 forces. The paper highlights one force as particularly dominant.
Threat of new entrants. Greenwald argued this, and Mauboussin agrees. If barriers to entry are high, incumbents can breathe a lot easier. They worry less about the other forces because potential competitors just can't get in easily.
It dictates pricing power.
Fundamentally. To appreciate why barriers are so crucial, you need to see just how much churn normally happens in industries.
What does the historical data show on entry and exit?
Looking back at U.S. manufacturing, 1963 to 1982, you typically see something like 30 to 45% turnover in the number of firms over just 5 years.
Wow, that's a lot of companies coming and going.
It is. And in terms of market volume, that churn affects maybe 15 to 20%. But here's the kicker for the entrants. The survival rates are grim.
How grim?
On average, about 80% make it through year one. But only about 50% are still around after 5 years. Half fail.
So if the base rate of failure is 50% in 5 years, why do so many entrepreneurs still jump into tough industries? Is it just optimism?
It's largely overconfidence bias. Entrepreneurs focus on their unique idea, their passion, their team, and they tend to ignore the statistical reality that most ventures like theirs fail. It's the "it won't happen to me" effect.
We saw this play out dramatically in airlines after deregulation, didn't we?
Oh yeah, 1978 deregulation opened the gates. Suddenly, tons of new airlines popped up. People thought, great, low barriers now. But most of them failed spectacularly within a few years.
Why? What were the hidden barriers?
Because even without regulation, you still needed massive capital for planes. You needed access to limited slots at busy airports. You needed established route networks and brand recognition. The structural barriers were still incredibly high.
Okay, let's break down the structural barriers. What are the main types? Let's start with the classic one, economies of scale.
Right. Supply-side economies of scale, often driven by high fixed costs. Think building a giant factory or a complex distribution network. There's something called minimum efficient scale, MES. That's the production level you need to reach to get the lowest possible cost per unit.
And how does MES create a barrier?
If the MES is really large compared to the total size of the market, the total addressable market or TAM, then maybe only one or two companies can operate at that efficient scale and make money. Anyone smaller just can't compete on cost. There isn't room for lots of players.
That feels like an old-school industrial moat. What about today's economy, dominated by tech and services? Is scale still relevant?
It is, but it looks different. It leads us to intangible investments. Companies today invest far more in intangibles, software, R&D, branding, than tangible assets like factories.
And the paper highlights one intangible in particular.
Proprietary software. The rise of superstar firms, the tech giants, is strongly linked to massive ongoing investment in their own custom software platforms. This spending is actually growing faster than traditional R&D or advertising.
How does that software build a moat? Isn't software easy to copy?
Good software is, but great, deeply integrated, proprietary software platforms are incredibly hard to replicate. Think about Amazon's logistics systems or Google's search algorithms. They allow scale and differentiation. And because they're complex and constantly evolving, they diffuse very slowly. A competitor can't just download it. They'd have to spend years and billions trying to build something equivalent. It raises the MES and the capital requirements enormously.
Okay, scale on the supply side. What about the demand side? Network effects.
Ah, yes. This is huge in the digital world. Network effects mean the value of the product or service increases for every user as more users join.
Like social media or ride sharing?
Perfect examples. More riders attract more drivers, which makes the service better for riders, attracting even more riders.
Yeah.
It's a positive feedback loop. This creates incredibly powerful lock-in and often leads to markets where one or two players dominate. It's very hard for a new entrant to break into an established network.
Another form of lock-in is switching costs. What makes it hard for us as customers to change suppliers?
There are direct costs, like penalties for breaking a contract. Indirect costs, like the time and effort to transfer data or learn a new system. And psychological costs, like just the comfort of habit. The paper lists 4 main types of lock-in.
Okay.
Brand loyalty, just trusting a familiar name. Compatibility, think Apple's ecosystem, where switching means replacing hardware and software.
Yeah.
Data lock-in. Imagine moving years of photos from Google Photos.
Right.
And learning curves the hassle of mastering a new interface, like switching from Microsoft Office to something else.
All friction that keeps us put. Then there's asset specificity. What's that about?
This is about investments made by either the supplier or the customer that are highly specific to their relationship, making them hard to redeploy elsewhere. It creates mutual dependence. Could be site specificity, like a bauxite mine located right next to an aluminum smelter built specifically for that mine's ore. Or physical specificity, a supplier making a custom tool that only works with one customer's machinery. Or even human specificity, employees developing highly specialized skills that are only valuable within their current company. If your business relies on these specific assets, switching suppliers or customers becomes incredibly costly and risky.
Incumbents don't just rely on existing barriers, they actively build new ones, like with pre-commitment contracts.
Absolutely. This is about locking things down for the future, securing critical inputs, or guaranteeing future sales. The Amazon example is brilliant, buying a data center and signing a long-term deal for nuclear power.
Why is that such a strong move?
They secured a massive, clean, and potentially low-cost energy source for decades. A competitor wanting to match that might have to build their own nuclear plant. It's a huge capital barrier created through a forward-looking contract.
And the last barrier, regulation, often seen as a necessary evil, but the paper quotes Bill Gurley.
Regulation is the friend of the incumbent. It's often true. Things like licenses, patents, think 20 years for pharmaceuticals, or even regulatory capture, where regulations unintentionally or intentionally favor existing players, all make it harder and more expensive for new companies to enter and compete.
Okay, that covers keeping new players out. What about the fight among the existing players? Force number 2, rivalry.
Right. How intensely do the companies already in the industry compete against each other? You measure by looking at things like price wars, advertising battles, how quickly they add new capacity, service competition.
There's always a tension, isn't there? Cooperate or compete.
Exactly. Do firms sort of tacitly coordinate to keep prices stable and profits high? Or does someone always cheat by cutting prices or adding a ton of new capacity hoping to grab market share, even if it hurts industry profitability overall?
What factors tend to crank up the intensity of that rivalry?
Several things. Having many competitors who are all roughly the same size. No dominant leader. Slow industry growth is a big one. If the pie isn't growing, the only way to win is to take share from someone else, which leads to fights.
And network effects can actually increase rivalry. That seems counterintuitive.
Sometimes, especially in the early stages, think about the ride-sharing wars. Uber and Lyft were burning through venture capital, heavily subsidizing both riders and drivers. Why? To win the network. They were essentially paying customers to use their service, leading to brutal price competition and massive losses, all fueled by the belief that dominating the network was the only way to long-term profits.
The paper gives us a metric to gauge this: market share instability. How does that work?
It's simple but effective. You look at the average change in market share for the top players over, say, 5 years. Take the absolute value of those changes.
And what's a stable number?
A rough rule of thumb is, if that average change is 2% or less per year, the market structure is pretty stable. The leaders aren't changing positions rapidly.
What does the data show for different industries?
It's quite revealing. Industries like auto manufacturing or search engines are very stable, around 1% instability. The big players have solid positions. But look at social media or web browsers. Instability is higher, maybe 3%. It suggests a much more dynamic, ongoing battle for users. Interestingly, U.S. airlines, despite their poor profitability, actually had low instability, around 1%, between 2018 and 2023, suggesting the main players have somewhat entrenched positions, even if they aren't highly profitable.
Okay, we've covered the 5 forces that shape competition within an existing structure. But structures themselves can change, sometimes dramatically. This brings us to disruptive innovation, Clayton Christensen's famous concept.
Right, and the crucial point Christensen made, which the paper emphasizes, is that disruption isn't fundamentally about technology. It's a business model problem.
What does that mean exactly?
It means that disruptive innovation often uses technology, sure, but its power comes from enabling a new business model that the established players, the incumbents, cannot or will not adopt.
Why wouldn't they adopt a winning model?
Because adopting it would directly harm their existing profitable business. They face what's called counterpositioning. Their current success traps them.
And this often happens because incumbents overshoot the market.
That's the mechanism. They get caught up in sustaining innovation, constantly adding features, improving performance for their most demanding, highest-paying customers. Think more megapixels, faster processors, etc.
Eventually.
They offer more performance, more features, and higher prices than the majority of the market actually needs or is willing to pay for.
Yeah.
They've overshot the bulk of their customers.
So as a customer, I might look at the latest high-end gadget and think, that's amazing, but honestly, last year's model is fine and it's way cheaper.
Exactly. You've been overshot. And that creates an opening. A disruptor can then enter with a product that might seem inferior on the surface, fewer features, lower performance, but it's good enough for that overshot mainstream market. And it's usually much cheaper or simpler.
The paper mentions 2 types, low-end and new market disruption.
Right. Low-end disruption targets those overshot customers at the bottom of the market with a cheaper, simpler alternative. Southwest Airlines is a classic example. Initially, they weren't competing directly with the major carriers on fancy service. They were competing with bus travel or driving, offering a basic low-cost flight.
And new market disruption.
That competes against non-consumption. It creates a market where none existed before by making a product or service simple enough and affordable enough for people who previously couldn't access it. The personal computer versus the mainframe is the canonical example. PCs enabled individuals and small businesses who could never afford a mainframe to start using computers.
One of the most fascinating, almost tragic parts of disruption theory is how incumbents often choose to retreat from the disruptor.
Yes. The integrated steel mills example is perfect. When mini mills started making cheap, low-quality rebar, the very bottom of the steel market, the big integrated mills thought, good riddance, that's a low-margin business anyway. We'll focus on high-end sheet steel.
So their profit margins actually went up in the short term by abandoning the low end.
They did. Wall Street probably cheered. But by seeding the rebar market, they allowed the mini mills to gain a foothold, generate cash flow, improve their technology, and gradually move upmarket. Eventually, those mini mills started making higher quality steel, directly attacking the incumbents' core profitable business. The incumbents were, as Christensen put it, motivated to flee directly into the path of their eventual demise.
A strategic retreat that turned into a rout. Okay, shifting focus slightly within industry structure, how companies organize themselves, vertical versus horizontal integration.
This is about how much of the value chain a company controls directly. Vertical integration means you do almost everything yourself, from raw materials, maybe all the way to the final customer. Think old Ford River Rouge plant. Horizontal integration means you specialize in one part and rely on partners or suppliers for the other steps. Lots of outsourcing.
Why do industries often start vertically integrated?
Usually because of high coordination costs early on. When a product or system is new and complex, like the first computers in the early 80s, it's just easier to design and build everything in-house to make sure it all works together. Everything was bundled.
But then things change.
As the industry matures, the interfaces between different components become standardized. Think standard USB ports or how PC components became interchangeable. This allows for modularization. The industry can then flip to a more horizontal structure, with specialized companies making the best processor, the best memory, the best operating system, and they all work together. That's what happened to the computer industry by the mid-90s.
This vertical versus horizontal debate feels incredibly relevant to the electric vehicle market right now.
It's playing out in real time. Tesla took an absurdly vertically integrated approach, as the paper calls it. They control the battery tech, the software, the charging network. Why? Because EVs are still relatively new, complex systems, and that tight integration helps ensure performance and user experience. High coordination costs favor vertical integration.
Contrast that with Ford.
Ford trying to apply the traditional horizontal auto industry model. They relied on numerous external suppliers for something like 150 different software modules for their EVs.
And the result?
It was a nightmare for them initially. They were losing tens of thousands of dollars on every EV sold in early 2024, largely because getting all that outsourced software to work together seamlessly was incredibly difficult and costly. Now you see Ford and other legacy automakers trying to bring more software development back in-house. They're trying to re-verticalize around the critical components for EVs because they realized the old horizontal model wasn't working for this new type of product. It shows how the optimal structure depends on the maturity and complexity of the industry.
Okay, we've mapped the terrain, analyzed the forces, looked at disruption. Now let's zoom back in on the individual company. How does a firm actively engineer its moat? The paper uses the value stick concept here.
The value stick is a really helpful visual. It lines up 4 key points. Customers' willingness to pay, WTP at the top, then the price the customer actually pays, then the company's cost to produce, and finally the supplier's willingness to sell, WTS, at the bottom, which is like the supplier's own cost.
And the gaps represent?
The gap between WTP and price is the consumer surplus, the value the customer gets but doesn't pay for. The gap between price and cost is the firm's profit or value captured. And the gap between cost and WTS is the supplier surplus, the profit the supplier makes.
So the company's goal isn't just to maximize its own slice, price minus cost.
Not solely, no. The real strategic goal is to make the entire stick longer. You want to increase the total value created by pushing WTP up and or pulling WTS down. Then you figure out how to share that bigger pie.
Why share? Why not just grab the biggest possible slice for the firm? That seems counterintuitive for maximizing profit.
It's about sustainability and building a stronger ecosystem. If you increase WTP but keep prices reasonable, you create more consumer surplus, which attracts more customers and builds loyalty, think demand-side benefits. If you lower your costs but share some of that gain with suppliers, letting them keep some supplier surplus, you build stronger relationships, get better reliability, maybe faster innovation from them.
So sharing the value actually reinforces the moat.
Exactly. Concepts like Costco's scale economies shared, passing savings to customers, or creating more value than you capture, it makes the whole system stickier and harder for competitors to attack. You're not just maximizing short-term profit, you're building long-term resilience.
Okay, let's look at the 2 main strategies for lengthening that stick. Strategy 1, differentiation, pushing WTP higher. How do companies do that?
One powerful way is through complements. Making a complementary product cheaper or better can significantly boost the WTP for your main product.
Google and Android is the example.
Perfect example. Google gives Android away for free. Why? Because Android phones are complements to Google search. More Android phones mean more mobile searches, which is where Google makes its money. The free complement drives demand for the profitable core product.
But these complementary relationships can get messy, the frenemy problem.
Absolutely. Look at Epic Games maker Fortnite versus Apple and Google over the App Store fees. Fortnite needs the mobile platforms, iOS, Android, and the platforms benefit from popular apps like Fortnite. They are complements.
But they fight over the money.
Fiercely. That 30% cut. It highlights the tension. They need each other to create value, but they constantly battle over how that value gets divided. Who gets which slice of the value stick?
Beyond compliments, what else drives WTP up?
Status is huge, especially in luxury. The paper cites the Tiffany versus Costco diamond ring comparison.
Tell us about that one.
Okay, so you have two objectively similar diamond rings. The Tiffany ring costs maybe $10,000 more than the Costco one, but an independent appraisal finds only about a $2,500 difference in the actual diamond's value.
So the extra $7,100 is?
Pure WTP premium. It's for the Tiffany brand, the blue box, the prestige, the social signaling. It's value created entirely through differentiation and status, not the physical product itself. That's a powerful moat.
What else?
Habit is a subtle one. For frequently purchased items like, say, your favorite brand of toothpaste or soda, habit reduces your price sensitivity. You just grab it without thinking. That's a form of horizontal differentiation. And reducing search costs helps too. Think Amazon's recommendations or Netflix's algorithm. They make it easy to find things you like, increasing your WTP for the convenience and personalization. You stick around.
Okay, that's raising the top of the stick. Now, strategy 2. Cost leadership, pulling the bottom, WTS, down. How do firms lower costs beyond just squeezing suppliers?
Data sharing is a really smart way. The Walmart and Procter & Gamble example is classic.
What do they do?
Walmart shared detailed point-of-sale data with P&G. This allowed P&G to see exactly what was selling where in real time. That meant P&G could manage its inventory and supply chain much more efficiently. They needed less working capital, their inventory turned over faster.
How does that lower WTS for Walmart?
Because P&G became more efficient, their own costs went down. The paper shows how this works with ROIC. Let's say P&G starts with a 10% profit margin and turns its capital 1.5 times a year. That's a 15% ROIC. With Walmart's data, maybe their turnover increases to 2.0 times. Now P&G can actually lower its margin to 7.5%, giving Walmart a lower price, and still achieve the same 15% ROIC, 7.5% by 2.8 to U equals 15%.
Wow. So P&G maintains its return, Walmart gets lower cost, the customer potentially benefits too. It's a win-win-win driven by data sharing.
Exactly. It expands the supplier surplus and allows for lower costs down the chain. Another huge lever for lowering WTS is balance sheet productivity. Amazon is the absolute masterclass here.
This involves the cash conversion cycle, or CCC.
Right. CCC measures how long it takes from paying for inventory to collecting cash from the customer. DSO, days sales outstanding, plus DIO, days inventory outstanding. Yeah. Minus DPO, days payables outstanding.
What was it for traditional bookstores?
Around 80 days. They hold books for a while, waited for customers to pay, and paid publishers relatively quickly.
And Amazon?
Amazon flipped it. They achieved a negative CCC, often around negative 30 days.
Negative 30 days? How does that even work?
It means they collect cash from you, the customer, almost instantly when you buy something online. They hold inventory for a very short time, high DIO. And crucially, they stretch out payments to their suppliers, high DPO. So they get your cash long before they have to pay their own suppliers.
So the suppliers are effectively financing Amazon's growth?
In a way, yes. This negative CCC acts like a perpetual interest-free loan from suppliers that grows as Amazon grows. It's an incredible source of cash and a massive competitive advantage, effectively lowering their cost of doing business, WTS.
Lastly, on cost, the paper mentions economies of density, using Walmart again. Scale isn't always an advantage.
It has to be the right kind of scale. Walmart's early success and incredibly high ROIC came from building a dense network of stores and distribution centers clustered tightly around their home base in Bentonville, Arkansas. Super efficient logistics within that cluster.
But as they expanded nationally...
As they expanded across the country, that density advantage diluted. Logistics got more complex, costs per store went up relative to the early days. Their overall ROIC started to trend down towards their cost of capital. It shows that scale advantages are often geographically specific and need to be defended.
Okay, we have the strategies. Now, how do we tie this back to the financials and assess which strategy is driving success? The DuPont analysis.
Yes, this breaks down ROIC into its core components. ROIC equals NOPAT margin. That's net operating profit after tax divided by sales, multiplied by invested capital turnover. Sales divided by invested capital.
So margin reflects pricing power and differentiation.
Generally, yes. High margins usually mean you're doing something unique that customers will pay more for, increasing WTP.
And turnover reflects efficiency and cost leadership.
Right. High turnover means you're generating a lot of sales from a relatively small base of invested capital, being efficient, maybe lowering WTS.
Looking at the most successful companies over the long term, which component tends to be more important for sustaining high ROIC? Is it margin or turnover?
The data in the paper is pretty clear on this. Differentiation, reflected in high NOPAT margins, seems to be the more significant and durable driver.
How much more significant?
The top ROIC companies had NOPAT margins that were, on average, 4.4 times higher than the average company in the universe studied. Their invested capital turnover, while also better than average, was only 1.8 times higher.
So the margin advantage was much bigger than the turnover advantage for the best performers.
Yes. The strategic implication seems to be that while cost leadership is important, building a truly durable moat is more often associated with creating something unique that commands higher prices, focusing on being better before cheaper, or driving revenues before obsessing solely over costs. Differentiation seems to have more staying power, #government, games, and the limits of brand.
We're nearing the end, but we have to acknowledge factors outside the direct company-customer-supplier dynamic. Government plays a huge role, doesn't it?
Immense. Government policy is like an external force that can reshape the entire competitive landscape overnight.
Examples.
Tariffs are obvious. The 2024 U.S. tariffs on Chinese semiconductors and EVs instantly changed the cost calculations for firms in those sectors, both domestic and foreign. On the flip side, you have industrial policy.
Like the GPS Act.
Exactly. The GPS and Science Act pumps $280 billion into boosting U.S. semiconductor manufacturing. That's government actively trying to build domestic capacity and implicitly protect certain firms or industries.
And then there's the stick, antitrust. That seems like a growing concern, especially for big tech.
It's a major factor. Just being under antitrust investigation, even if you ultimately win, is incredibly costly. Huge legal bills, massive drain on senior management's time and attention, potential restrictions on future mergers and acquisitions.
It limits strategic options.
Absolutely.
Yeah.
For companies like Amazon, Apple, Meta, Google, the current wave of antitrust scrutiny around the world is a significant external force that could definitely shape the future trajectory of their moats.
Okay, away from government, how do firms interact with each other? Game theory comes into play here, starting with the classic prisoner's dilemma.
Right. The paper uses a simple airline pricing example. Two airlines, same route. Flight cost is $160. They could both charge $220, cooperating, or cut the price to $200, competing or cheating.
What happens if they cooperate?
If both charge $220, they each make $60 profit. $220, $160. Total industry profit is $120. Well, it's good. But if it's a one-time decision, each airline thinks, if the other guy charges $220, I can make more by charging $200 and grabbing more passengers. If the other guy charges $200, I definitely have to charge $200 just to stay competitive.
So no matter what the other guy does, charging $200 seems like the best individual move.
That's the Nash equilibrium. Both airlines rationally choose to charge $200. They each end up making only $40 profit, $200 and $160. Total industry profit drops to $80. They're both worse off than if they had cooperated, but they got there through rational self-interest.
That explains why price wars happen even when they hurt everyone, but reality isn't usually a one-shot game, is it?
Exactly. Businesses interact repeatedly, and in repeated games, strategies change. Things like tit for tat can emerge.
Explain tit for tat.
It's simple. Cooperate on the first move. Then on every subsequent move, just do whatever your opponent did last time. If they cooperated, you cooperate. If they cheated, cut prices, you punish them by cheating next time. Over the long run, this simple strategy tends to encourage cooperation and leads to higher payoffs for everyone. It shows how tacit collusion can develop even without explicit agreements.
Now, what about asymmetric warfare, when one player is much weaker? Colonel Blotto's strategy.
Colonel Blotto is a fantastic model for underdogs. It's about resource allocation across multiple battlefields. Imagine you have fewer soldiers than your opponent. How do you win?
Not by fighting head-on everywhere.
No. The lesson for the weaker player is to increase the number of battlefields. Don't fight the giant where they're strongest. Instead, spread your resources and attack them on multiple smaller fronts, perhaps in unconventional ways where their size might actually be a disadvantage.
How does this apply in business?
Think about Breeze Airways again. Instead of challenging the major airlines at their big fortress hubs, Breeze focuses on underserved point-to-point routes between secondary airports. They're creating new, smaller battlefields where the majors' complex hub-and-spoke systems and large planes aren't well suited. It's a classic Colonel Blotto move, and it aligns perfectly with disruptive innovation, finding niches the incumbents ignore.
Brilliant. Okay, last topic, brands. We often think of a strong brand as the ultimate moat. Is it always?
It can be, but it has to pass the value test we talked about earlier. Does the brand actually increase willingness to pay or lower willingness to sell?
So the Tiffany example, the brand clearly increases WTP through status.
Yes. Or think about trust and risk reduction. Charlie Munger used to talk about choosing Wrigley's gum over some unknown brand, even if it cost a bit more, just because you trust it's safe. That reliability signal increases WTP.
Can a brand lower WTS for supplier?
It can. Imagine you're a small food producer. Getting your product onto Walmart's shelves gives you instant credibility and massive distribution. That imprimatur of Walmart is so valuable that you might offer Walmart a lower price, lower WTS for Walmart, just to gain that access and association.
But the paper warns against relying solely on brand rankings.
Absolutely. Exhibit 39 shows a surprisingly weak correlation between being ranked as a top global brand by agencies like Interbrand and actually having a high Moat indicating ROIC, adjusted for accounting differences.
So a famous brand doesn't automatically equal a strong moat?
Not necessarily. The brand is only valuable if it translates into tangible economic results. Higher prices, more loyal customers, better supplier terms that ultimately lead to that sustainable ROIC spread over WACC. ROIC is the real proof of the pudding, not just the brand name recognition. Hashtag outro.
Well, this has been incredibly insightful. Pulling it all together, this framework from Mauboussin and Callahan, combining the big picture industry analysis, the 5 forces, disruption, integration, with that deep dive into the firm's own strategy using the value stick and DuPont. It really feels like a systematic way to measure the moat.
It is. It moves beyond just looking at current profits and forces you to analyze the underlying structure and activities that generate those profits. And the key lesson for you, whether you're analyzing a company or even thinking about your own career strategy, is that it's all about establishing a difference that you can maintain.
Against that relentless pressure of competition and regression to the mean.
Exactly. Strategy isn't about being the best at everything. Porter said it's about being unique. It's about the trade-offs you make to defend that uniqueness. So don't just ask, what are the returns today? Ask, what activities create those returns, and are those activities defensible?
And perhaps a final thought to leave everyone with, something Warren Buffett himself pointed out.
Yeah, he said moats are never static. They're always either widening or narrowing, even if it's happening slowly, subtly, almost imperceptibly in the short run.
So the real challenge isn't just measuring the moat today.
No. The real challenge and the real source of potential excess returns for investors is anticipating the trajectory. Is that moat getting wider or narrower? Understanding the forces acting on WTP, WTS, and the barriers, that's how you gauge the sustainability and the future direction of that crucial ROIC spread. That's the ultimate goal.